In this part of the course, we'll talk about the nuances of approaching the understanding of market dynamics from a multidisciplinary perspective and trading from an interdisciplinary perspective. The problem of trading is preceded by the problem of understanding the dynamics of financial markets. Understanding the dynamics of financial markets is often a multidisciplinary problem, and understanding trading is often an interdisciplinary problem. A multidisciplinary approach means that a problem can be seen through multiple perspectives that run parallel to each other, and each perspective provides its own insights about the problem in question. An interdisciplinary approach means that the solution to a problem can be integrated or synthesized using insights from multiple perspectives in a shared language. For example, the dynamics of financial markets can be seen through the lens of economics, physics, and mathematics in parallel, so it's a multidisciplinary problem most of the time. Trading, which involves a trading strategy, must integrate insights from multiple branches of science in one shared language, so it's an interdisciplinary problem most of the time. It's possible to understand how price behaves based on knowledge about market dynamics, and it's also possible to understand how some things of how markets work based on knowledge about price dynamics. For instance, basic principles of economics shed light on how market dynamics makes price move in a particular way. Fractal geometry and nonlinear dynamics, which are branches of mathematics that study the phenomenon of chaos, shed light on how price behavior reflects certain aspects of market dynamics. It's important to point out that understanding market dynamics from price is entirely dependent on using the correct frameworks to understand price. Another important aspect of the requirement for an interdisciplinary approach in trading is that there are many occasions in trading where the origin of the problem is explained by one field of science, but the consequence of this problem is explained by another branch. If the trader doesn't have an interdisciplinary approach, the trader will only be able to have a reactive approach to the problems of trading instead of a proactive approach. In a reactive approach, the trader can detect the consequence of the problem, but he cannot detect and understand the origin of the problem, and therefore, he cannot understand the interplay between origin and consequence. The problem with that is that this type of approach leads to temporary solutions and irrational allocation of the trader's resources, such as time and money. In a proactive approach, the trader not only understands the consequence, but he can also understand the origin of the problem, and therefore, the interplay between origin and consequence. This is the optimal solution because it leads to the prevention of problems and the rational allocation of the trader's resources. There's a problem here, of course, because it's very difficult, if not impossible, to be an expert in multiple branches of science. This leads us to the concepts of depth and breadth of knowledge and the trade-off between the two. Depth of knowledge refers to how deeply one understands a topic. Breadth of knowledge refers to the number of topics one understands. An expert has great depth of knowledge about one topic. A polymath has depth of knowledge across a few different topics. Notice that there is a trade-off between depth and breadth of knowledge. The greater the breadth, the lower the depth. Being an expert in one field of science leads to a reactive approach, so it's not the optimal solution as we already saw, and being a polymath it's too hard. We need insights from multiple topics, but of course it's impossible to be an expert in all of them. So reasonable depth and reasonable breadth of knowledge are required. Knowing when to seek depth and when to seek breadth of knowledge is also part of this paradigm. It's very common to see experts in their own field thinking they have an edge in trading. For example, an expert in mathematics that is oblivious to the problems of behavior in trading thinks he has an edge due to the fact that financial markets are obviously related to mathematics, but this confidence comes from the fact that he doesn't know the interdisciplinary nature of trading. One common issue here is to expect mathematical robustness from behavioral tools. The opposite is also true. An expert in behavioral finance that is oblivious to mathematics will have a similar problem. For example, not knowing some concepts of game theory will lead to a counterproductive learning approach. Not knowing concepts in performance appraisal, such as benchmarking and risk-adjusted metrics, will lead the trader to seek the right way of learning how to achieve the wrong goal. We can make a metaphor to summarize the essence of this paradigm that relates the multidisciplinary nature of market dynamics and the interdisciplinary nature of trading. Navigating the vast ocean of knowledge, one can relate depth of knowledge to diving deep into the waters, exploring the mysteries hidden in the abyss, uncovering detailed treasures that lie beneath. Breadth of knowledge is akin to sailing across the wide expanse of the sea, charting the connections between distant lands, understanding the variety of cultures, climates, and terrains that compose the world. True mastery and the ability to solve complex interdisciplinary problems require the skill of both the deep-sea diver and the world-traveling sailor. Just as a diver might miss the interconnectedness of the world's oceans, and a sailor might overlook the treasures hidden in the depths, focusing solely on depth without breadth or vice versa limits one's perspective and capability. The most adept explorers of knowledge know when to dive deep, uncovering the intricacies of a specific domain, and when to sail broadly, connecting different pieces of wisdom across disciplines. This balanced approach ensures not just an understanding of the parts, but a comprehension of the whole, enabling one to efficiently navigate the interdisciplinary challenges. In trading, it's common to find problems that originate in mathematics and that have a behavioral consequence. The opposite is also true. Certain problems are born in behavior and have a mathematical consequence. For example, the lack of knowledge about the correct mathematics of risk management leads to the reinforcement of behaviors that appear to be good in the short term, but are bound to fail in the long term. Lack of understanding about basic principles of game theory, a branch of mathematics that deals with strategic interaction and rational decision-making, leads traders to believe that trading is only a game of skill and ignore the role of randomness in the process. The consequence of this is behavioral. When traders think in that way, they become unaware of the existence of false positive and false negative errors that will reinforce the wrong behaviors in a non-obvious way. Some issues have their origin in behavior, but they lead to mathematical consequences. For example, the unawareness of hyperbolic discounting, which is the tendency of preferring smaller and immediate rewards over larger and delayed rewards, leads to many small and frequent wins in the short term at the expense of large losses in the long term. The high frequency of small short-term wins induces an illusion of skill that is frustrated when long-term large losses occur. The effects of hyperbolic discounting can be measured and sometimes anticipated mathematically, but that requires knowledge about hyperbolic discounting in behavioral finance and knowledge about the mathematics of risk management. The unsustainability of the mode of action bounded by hyperbolic discounting in the financial markets can be perceived using a mathematical approach. One of the most common misconceptions about trading occurs when traders expect mathematical validity from behavioral tools. The confusion emerges because the tools that highlight behavioral patterns have a mathematical connotation. This happens a lot with moving averages and chart patterns. People expect moving averages to have mathematical validity in describing price action because they immediately link the idea of average with mathematics, which is a perfectly honest and expected mistake. Moving averages were born in the field of signal processing, but they are unreliable to describe price action mathematically for a variety of reasons. Moving averages fail to capture the nonlinear patterns in geometric data like price action on a chart. Moving averages filter price noise at the expense of adding lag to the signal, which defeats the initial purpose of the moving average, to provide timely reversal signals. The moving average period is almost always chosen arbitrarily. The appropriate moving average period varies according to the type of market scenario, and different market scenarios change with a high degree of unpredictability. Moving averages generally assume that the underlying data is stationary, meaning that the statistical properties do not vary over time. Price action is non-stationary, meaning that its mean and standard deviation vary over time. Another way of using a moving average is to treat it as a barrier for price. The reason we can sometimes see price reacting to moving averages as if they were a physical barrier is neither mathematical nor physical, it's behavioral. The reason you can see price bouncing off a moving average sometimes is the self-fulfilling prophecy effect, which is a behavioral phenomenon, not a mathematical or physical phenomenon. A lot of traders act as if price will treat the moving average as a barrier, so when price meets the MA, traders act accordingly, which makes price indeed react to the MA. The initial false belief that moving averages are a barrier makes the belief become true, since the market is a mechanism that reacts to predictions about itself. In chaos theory, this is called second-order chaos. That leads to the question of why price sometimes completely ignores the MA. The reason is because this type of reaction only occurs when there isn't a stronger force acting on price action at the same time. For instance, a moving average bounce will never be stronger than a macroeconomic force. Recall that the outcome of your trades is affected by the actions of multiple market players, many of which you don't know and don't understand. A similar phenomenon occurs with chart patterns. Chart patterns work sometimes not because triangles and rectangles explain price, but because people act as if the underlying logic highlighted by simple geometric shapes work. The reason these reactions don't work all the time is because if there are other stronger forces acting on price, the self-fulfilling prophecy effect from these tools in isolation is not enough to make price reverse most of the time. However, most people don't realize that there are different types of self-fulfilling prophecies in trading, some of which are useless and some of which are useful. Some critics of technical analysis satirize the drawing of simplistic geometric shapes in the price chart, and they are correct to a certain degree, because Euclidean geometry in isolation cannot explain the fractal geometry of price. That's why we need fractal geometry. However, the simple geometric shapes are simply an easy way for beginners to spot a certain pattern of highs and lows, which have a universally accepted logical interpretation. For instance, a rectangle is used to highlight a ranging market. When price breaks above or below the rectangle and bounces back to the support or resistance, there is an indication that a trend will follow. This has nothing to do with the rectangle per se. This is about the universally accepted interpretation of ranging and trending markets and the switching mechanics of support and resistance lines. The rectangle is just a way to categorize the pattern more quickly. It's not supposed to explain market dynamics with Euclidean geometry. However, the critics of these patterns often make that mistake because they don't understand chart patterns from an interdisciplinary point of view. Once again, the confusion emerges because the tool that highlights a behavioral pattern has a mathematical connotation. However, there are tools that aim to capture or describe the motion of price from the point of view of mathematics or physics, not just behavior. This is the case with the Andrews pitchfork and the linear regression channel. These tools are not widely used, so even though there can be a small self-fulfilling prophecy effect, they work because they capture a fundamental aspect of how price moves. The Andrews pitchfork was invented by Dr. Alan H. Andrews, which was an engineer. He based the pitchfork in Newtonian physics, and at that time, he was able to use the pitchfork effectively when nobody knew about it, so the two could not have worked due to the self-fulfilling prophecy effect in any way. Another important figure that became notorious for the use of Newtonian physics in trading was Roger Babson, an American economist and the founder of Babson College. Roger Babson made a fortune in the financial markets, and he was able to anticipate the 1929 crash using his physics-based approach to trading. The linear regression channel is an example of mathematical physical tool grounded in chaos theory. Chaotic systems are unpredictable, but they have stable statistical properties, so there is a certain predictability about the unpredictability of price when we look at it from the point of view of nonlinear dynamics, which is a mathematical field that can explain both mathematical and physical phenomena. The advantage in games of incomplete information, such as trading, dwells unsurprisingly in information that approximates the player to the completeness of information, which in the case of trading is the knowledge about the mode of action of diverse players when it comes to behavioral tools, and the knowledge about mathematics and physics of price. This information is not contained in price itself or in the trader. That's why the theoretical frameworks to read price are so important. Theoretical frameworks to understand price are like the lenses on Benjamin Franklin's spectacles. The superposition of lenses allows the observer to see the object in such a way that would be impossible without the spectacles. This idea touches on a fundamental aspect of understanding. Without the proper framework, one cannot see properly. In other words, the key doesn't lie exactly in the object being observed, nor in the observer. It lies in the correct mean of observation, although the observer will obviously play an important role, as we'll learn later in the course. Let's summarize what we have so far in a few key points. Market dynamics is a multidisciplinary problem, and trading is an interdisciplinary problem. Learning market dynamics comes before learning how to trade. We can learn about price by learning about the market, and we can learn about the market by learning about price using the correct frameworks. In trading, the origin of many problems is explained by one field of science and the consequence by another. An interdisciplinary approach leads to a proactive approach, which optimally allocates the trader's resources. In an interdisciplinary approach, knowing how to navigate the trade-off between depth and breadth of knowledge is critical. Common tools of trading such as moving averages and chart patterns cause confusion because they are behavioral tools with a mathematical connotation. The Andrews pitchfork and the linear regression channel are tools that can describe price action from a mathematical and/or physical perspective. Since markets are second-order chaotic systems, the right means of observation cannot be self-imposed. They dwell in the means of observation that are shared by diverse market participants and universal knowledge found in specific domains of science. In the next part, we'll talk about market dynamics from the point of view of economics. This finishes this second part. If you enjoyed the presentation, please help support the channel by clicking the like button, subscribing to the channel, activating all notifications, leaving your feedback in the comment section, and sharing this video with your trading community. Thank you very much for watching, and I hope to see you in the next part of the course. Take care.